Hey, welcome back to the show, Total Financial Solutions Safer Money Hour. Arif, Halaby, Jeff Gerard. Okay, some reasons you might need life insurance in retirement, might even want to carry it through retirement. Look, life insurance is this little weird thing. First of all, it used to be called death insurance. They had a marketing problem with that because a lot of people didn't want it. So believe it or not, they just changed the name from death to life insurance, and the world loved it, and suddenly people are buying millions of dollars of this stuff every year. So how did that all take place? Well, it took place by laying down a conversation that says it is there for your benefits, for your beneficiaries, for your children, for your wife, for your husband. It is designed for your business partner or the church, the charity. A lot of people are taking things like their life insurance. They're done with it and they're giving them, or selling them in some cases, but giving them to charities. Providence Holy Cross, the Boy Scouts, Henry Mayo. You can find a hospital, an organization, a charity, a church that can take over the ownership of it. In other words, you've just gifted that to them. They don't care. They'll get money hopefully someday when you pass away, but it's a long time off. And that now becomes your new gift to them.
It is. That's a wonderful gift, especially because it's a tax-free benefit. Now, they might enjoy that anyway because they're a charity if they qualify as one, but certainly that takes care of any questions when it's a life insurance policy proceeds.
And it gives your family, in some cases, a legacy, something to leave behind. Where you pass away, you want to have a hospital named after yourself, or a wing, or a surgery center, or a school. Those kinds of things could be named after you if that's you're so inclined. So it can be there for a charitable contribution donation. But there's other parts that can really be clear for your beneficiaries and for yourself, and that is, believe it or not, a pure sale of the life insurance. Jeff, we've talked about this topic on occasion, but for a lot of people, you forget that your life insurance is an asset. Your home that you live in, if you're paying the bills, we don't consider that an asset. If you buy a home and I pay your rent, or you pay your mortgage and through the rent, then that becomes an asset. But if it's a place where you have to go to work every day and you have to pay for it, and even if it's paid off, you have to pay, hundreds, if not $1,000 a month in property taxes and maintenance and repairs or HOA. When did it become an asset? Well, if it goes up. Oh, really? Ask the folks in 2008, 9, 10, 11.
Sure.
When things didn't go up and they went backwards quite a bit for quite a long time. So you want assets, things that build up your financial wealth over time and grow. Wonderful. I like that. But don't fall backwards when you are trying to build up your assets, the things that matter to you, and yet at the same time forget that a very valuable asset is a life insurance policy. Which means what? You have it. You want to sell it. There are companies and individuals and organizations out there that buy it.
That's right. And you may think that this is a policy that it was just a term policy, it didn't have any cash value, there was no equity in it, I couldn't draw from it, there's really nothing for me unless I die, and in that case it goes to my family. That's the closed-minded and very quick and simple view on most life insurance policies. But if you get to a place where, gosh, let's say you need to access the cash, and let's say it didn't have those policy benefits that we were talking about earlier, where you could draw on it, you might be able to sell it, and look, quite frankly, it's going to be at a discount. If you have a $500,000 policy, and there's no way for you to get any type of benefit from it while you're alive, there are companies out there, as Arif mentioned, that would potentially buy this from you.
Yeah, so think of it like this. If you have let's use the round number of $1 million life insurance policy. You earned $100,000 a year, you needed it for your spouse to pay for bills, your kids' college, whatever it is, but that responsibility has gone. You've built up your retirement accounts, your savings, your debt is paid down, and you still have this $1 million policy. You may have the opportunity to sell that. Now, if you call the company directly, the insurance company directly, they're not going to like that, because their goal was for you to pay for insurance, cancel it, and then die the next day. They don't care. They don't want to have to pay out $1 million. They know that if you sell it, that it now becomes in the new owner's best interest to keep that policy active. Meaning, the insurance company knows it will pay that $1 million. Doesn't matter what they say, who said it, they will pay it. Why? Because somebody has now invested money to make sure they do pay it. So that is a very big deal to an insurance company who counted on you dying the day after you canceled the policy, which means they paid nothing. All right? So
that's a big deal, because now you can start to negotiate with a company, and that $1 million policy in your example, Arif, could equal real dollars today for somebody. Let's just say on the conservative side, you sold it for $50,000. You were going to let this policy lapse. Now it might be more, it might be much more than that. But there's a couple of factors in there, and that's between you and the company. But just take a look at the concept for a minute. You were paying premiums on this policy for that protection. If you passed, the company paid $1 million out. But a third-party company says, look, we'll give you, in my example, $50,000. Well, you go, gosh, that'll help pay back some of the premiums I put out. That helps me get some of my money back. And gosh, I was just going to let this thing lapse anyway. But this other company takes it over, you assign that $1 million, you sign it away, and you say, look, when you give me that 50, I don't get any part of the million except what you paid me up front. Now the other company makes the premiums, and then when you pass, then that's when they reap their investment benefit. However, that money that you give up, you get something tangible today, which may go, like I said, to paying some of the monies back that you put out. But if you're sick, if you need some type of monies today, that's a very nice repayment for something you were going to let go anyway.
So that is important if you are trying to say, I have this asset, I want to get rid of it, I don't need it. If you still need it and you still want to keep it for the death benefit, then of course don't sell it, right? But in Jeff's example of $1 million and $50,000 coming back, remember, when you buy life insurance, your goal is to be as healthy as possible. You say, oh no, look, see, I can hop around on one leg, I'm good.
Yeah.
Right? Because the purpose is you want the lowest payment possible. You want to be preferred in your health, etc. So think of it this way. If you're selling the life insurance, you want to be as sick as possible. Sounds a little bit morbid, but follow me for a minute. They will buy a life insurance policy if they think they're going to give you $50,000 and then you die the next day, and they have $1 million policy in their hand. That's a huge rate of return. Those guys win big. But if you're really, really sick, they might give you more money, right? They might say, we'll give you $600,000, we'll give you $500,000, because they know within a 2-year period of time, they're going to make $1 million from the insurance company. But I used to think, and I still kind of, a little piece of me still thinks it's a little bit odd, but I understand it a lot more, because for the people that have these life insurance policies, but they need medical care, or they want to have that one last trip with their family, or they want to bring their mother from the old country to come and see them and before they die, or they want to go see her before they die, right? There's all these other things where just a little bit more money can make a difference. Then you are providing an opportunity, flexibility, and freedom to somebody who probably, if you were an investor, if you were a buyer of these, for example, that insurance policy gives those people a chance to do whatever they want to do while they're all still alive. So I can see that from both an investor and from a person who's selling it. The key, though, is this particular policy, once it is sold, your responsibility to make the payment is over. Your responsibility to pay the monthly amount, or all of that, is done. You do have one responsibility. Once a year, I think it's either by mail or letter or somehow, they contact you to see if you're still alive. And if you're not, you have to leave instruction to your beneficiaries, if you pass away, of course, within that year, to tell them, hey, by the way, you can collect on the money now. He's passed away. So that's the part of the conversation that gives your beneficiaries one responsibility. It doesn't give you a whole lot, but it gives your beneficiaries a responsibility. And
I know you mentioned the yuckiness factor that some people kind of get when they talk about this, including ourselves, but if you think about the access, and you touched on this, is the access to the money that they would not have otherwise had. I think the concept can actually serve a purpose for folks, for those, those last minute trips, or those things that they wanted to do they would not have otherwise been able to do financially. So I think if we just look at it truly from that aspect, we can kind of dispel some of that weird feeling that comes with it.
Yes. it gives you multiple choices that you would not have had you just decided that, hey, we're just going to let this policy go. And remember, the insurance company's best interest is for you to let it go. It's in their best interest to collect all the money and not have to do anything on the other side. That's what I don't want you to do. I want you to have paid the money and to get something back. Like Jeff said, maybe it's the $50,000 that you put out as a payment. You get that money back. Well, that's fine. Now you had life insurance, if you will, that cost you very little or nothing during the 20 years that you had it. Maybe the option is for you to buy the car you've always wanted to buy. Gosh darn it,
Right.
It's time for you to live a little bit. Or the RV, the vehicle, the beach house, take the trip. Whatever it is, it's the opportunity for you to live. And that is the key component to selling this. Whether it's paying medical care. I had a friend who sold his policy. Man, I've been doing this now 20 years, so it was probably 19 years ago. It was right when I first started.
Okay.
And he did a big block party. He sold it for like $100 and something thousand.
He sold his life insurance policy.
He did. It was 300 and see if I can remember the numbers. It was around 360,000, and I think he sold it for 150,000. And he had cancer in just about every body part, brain and lungs. And
Wow.
And he was, it was a surprise. He only had the life insurance policy less than 2 years, so he passed away. Sorry, he was given time on a terminal illness to pass away rather soon, but he didn't. And he continued to live, and as far as I know, he's still alive today. He relocated to Oklahoma, but
Sold his policy, got a cash settlement,
and he bought,
threw a block party, and then lived.
Bought an old Corvette for himself.
Oh, nice.
It's pretty cool. Bought a car for his mom.
Nice.
And threw a huge block party in the neighborhood where, they shut down the street and they had carnival games, and, it was it's what he did. But the buyers of it, they still have to make the payment, or they're out the $100,000 or whatever they gave them.
Right.
And tough luck for them. So I don't know if you're going to get those kind of numbers, 300,000 on a 45-year-old guy who's going to die. But sometimes people live, and you want the money. If you need the money now, that's what it's all about. We had one gentleman who took money out of his policy for a kidney transplant, I think it was, and the insurance wouldn't pay for this. This was back in 1997, 98.
Okay.
And he used his own money out of his policy to pay for that. Kind of weird. Sometimes you need it for different reasons, and that's one of them. So don't just throw it in the drawer. Don't just throw it away. Don't just stop making payments. Reach out to your financial professional. Certainly you can call us. We'll put you in touch with at least some ideas, and you can kind of follow through from there and see if that's right for you. But there may be some things that you can do to make some money back. And that's one of the reasons to keep life insurance in retirement.
Well, and I think just to clarify and finalize that last thought there, if you have an older policy, that's where you might start to see that there were no living benefits created back then, because people really lived under that old concept of they paid, and then if they died within the policy's life, then they were, their family was reimbursed. But otherwise that didn't happen. More and more we're seeing companies developing new products, new policies that have these living benefits, and I can't help but think that there's a little bit of that that strategy to not have people sell off their policies when they need cash, so you can actually access some of the benefits, some of the face amount of coverage without dying. So I kind of see it both ways, from the person's standpoint and from the insurance companies themselves.
One of the things that I have seen over and over again is when people will not spend their retirement income because they want to leave something for their children.
Yes.
They feel like they want to leave a legacy, they want to leave the house, they want to leave money because maybe they weren't able to provide a lot in other areas. And now I see this a lot with single moms. I see this a lot with dads that had been laid off and just trying to, life just didn't work out financially how they originally had thought. So they will often want to leave some of their home or their retirement money to their children, and so it affects the way they're going to live in retirement, because they have a line in which they're not going to spend past, and that can affect the way they want to live. So here is another option. When you are in retirement, and you might have a fixed amount of money like most of us do when we're retired, what are you going to spend when it comes through this process What are you going to spend per month? And I think you will have a little bit more freedom if you know that in the back of your mind, if you die, your beneficiaries are going to receive your life insurance. Then you might be a lot more comfortable with spending down your 401ks or your IRAs, because the life insurance itself will be there to make sure your kids receive the money. And by the way, Jeff, that money is taxed at a different rate, isn't it?
It sure is. It's tax-free under current law. So, and we've seen this a lot, and I don't want to digress from your point there, but we'll see some folks will leave life insurance to one child and their 401k or their IRA monies, their retirement monies that have not been taxed yet, by the way, to another child. So that can create some inequity there in the gift that they give, because one is way more tax favored than the other. But I do like what you're saying, is that so many people have that line where they do have to leave something, just whatever is innate in them, they have to leave something to their children so that they're left a little bit better. At least that's their comfort level. They're left a little bit better financially when they pass away. But think about this. If you give $1 or $100 or $1,000, it costs you $1, $100, or $1,000. If you want to give $1,000 in life insurance, that could buy you $10,000, it could buy you $100,000. So you're able to leave dollars for the cost of pennies, if you will, and then you just add zeros behind it to whatever your comfort level is, or whatever your budget allows. And for a very low cost means, you could leave 5 or 6 figures worth of tax-free money to your heirs and not have it affect your lifestyle. Too many times we've seen people, though, they won't take the trips, they won't buy the boat, they won't go on vacation, they won't do these lavish things in retirement, and when they pass away and all the money goes to their kids, their kids buy the boat, buy the car, take the trip.
Everything that you didn't want to do because you worked for the money and you value it, when the people inherit it, which are usually your children or grandchildren, they don't value it. They see it as just lotto or found money on the street. They don't understand the hard work that you put into it in order for it to even exist, the risks that you took or didn't take. That life attachment, that emotional attachment to that money doesn't exist. So I think life insurance is often a better way so you can free up that emotional connection to the money, spend it the way you want, not think that you have to leave your children something where it's not going to be there in the same value, right? So there's some components. We're going to come back in just a minute. I want to touch on one more thing before the top of the hour, guys. I think it's pretty important because it'll bring it all together on your place for news, talk, and information. Total Financial Solutions Safer Money Hour. I'm Arif Halaby. We'll be right back. Welcome back to the show, Total Financial Solutions Safer Money Hour. Arif Halaby, Jeff Gerard. We're talking about your family's finances, of course, retiring with a life insurance policy. When do you not need it? Let's kind of clarify that right off the bat. You don't need it if you have sufficient retirement income. You're able to leave the money that you want to your children or grandchildren when you pass away. Your charitable desire, contribution, connection is done, so you don't have to. You're not wanting to leave a big chunk of money behind the scenes to that group, and you've just decided that at the end, it had a purpose, served its purpose, and it's over. That's perfect. That's the purpose of life insurance often, is to fill the gap while you are trying to save money, pay off debt, build in retirement protection. What if one of you pass away before retirement happens? Look, by definition, retirement happens later in life, and because of that, you also get closer to dying the older we get. So sometimes those two intersect. Sometimes they cross before you actually pass away, and you're like, oh gosh, we had planned for these things to take place, and what do we do? So life insurance fills that gap. Pay off the house, we've seen those things, etc. But what about needing it? What are some of the reasons that you would keep it in retirement? Well, some policies are what's called a permanent plan or a cash value plan. Often oversold, meaning people have these plans when they shouldn't, because it pays agents very well, much better than a term insurance plan does. Give you a good example. A term insurance plan for $500,000 in life insurance might pay an agent, let's say, $400. A whole life insurance, where the client is paying the same amount, will not get $500,000, so they have to pay a lot more. So if you say, I want $500,000 in life insurance, If it's term insurance, the agent earns around $400. If it's a cash value insurance, they might earn $15,000, one policy. So you have to keep in mind that these always benefit the agents when you have a permanent plan. That's fine. I don't care. Let them do well. Let us do well. We're agents. Well, it's fine. But make sure it benefits you first. And then anybody else, that's their own business. But make sure that the purpose of this policy was to put your interest first, not the agent's. Consequently, because they're very well compensated, the amount of times that everybody is sold it isn't always the ones that really need it, which is a much narrower group. The ones that could use it, and when the purpose comes into play, is when you are older and you say, I want to live on some of the income. Because a permanent plan has your payment is broken into two buckets.
That's right. And one of those, and first and foremost, the cost of insurance to protect you for that $500,000 in this example, it gets paid first. But you overpay above and beyond that cost of insurance, and then the other part goes into savings. So you have one part paying for the insurance or the cost of it, and then the other one goes into savings. And hopefully, and I have to stress this, if a permanent plan, a cash value life insurance policy is built properly and it's funded properly, when you reach retirement age, this can be another means to supplement your income. And oh, by the way, if it's done properly, you can take money tax-free or at least tax-favored from this type of a program and have it last the rest of your life. And oh, by the way, whatever money you don't spend gets paid out in death benefit to your family. So again, properly built, you can see a multitude of benefits in having a permanent policy, but it has to fit the right person. I think permanent plans can be a great supplement so long as you've covered the need, whether it's term or a blend of term and permanent insurance. But going right to the permanent is not always the best way, or at least the most cost-effective means of doing that.
So, do I like the permanent plans? Yes, I do. If the purpose of those are designed for you specifically, if it has its job, then they are a fantastic way to get additional income 10 years from now in retirement, 6, 7, 8 years, 10 years, something like that, at least 7 or 8 years. But in the future, where it's additional source of income, because all of us know that Social Security hasn't given a pay raise of any significance for a decade. Really. I mean, they're not even keeping up with inflation. Your Social Security payment 10 years ago would buy you more than today by far. So what do? We have to make sure that your payment, that your lifestyle is going to be able to keep up with your income. So, or your income keep up with your lifestyle. We also know that pensions have seen an enormous amount of pressure, meaning people originally thought money was going to last a period of time and all of us were going to die a certain period. Just earlier this year, the life expectancy ratios changed, meaning you're now expected to live 32 months longer. Just in the last few years, things have changed and suddenly the numbers are up.
That's right.
32 months. Now, you might say that's not very long, but when you are a pension and you're paying thousands of people for an extra 3 years, oh my goodness, that's a lot of money going out the door. So pensions are probably not going to increase their income. Certainly not as much as inflation.
Or could even pare back a little bit.
And you're going to start seeing things cost more money every day, especially here in California. Instead of thinking in the state legislature, how do we reduce the pain for the consumer? How do we keep people from paying more in taxes and having more onerous regulations? It's just the opposite. It's incredible. We're a one-party state. You realize that. The whole state is virtually one party in government. And the Democrat Party has done one thing, and that is, still to this day, and even some of the Republicans, folks, it's not a one-way street, have said, how do we find another way to tax you? Oh, we haven't raised the tax on the marriage license for a while. Let's raise that fee. Oh, we haven't raised gasoline tax for a while. We want people to drive green cars and no gas emissions. Wonderful. Oh, wait a second. They're not going to buy gasoline, so we're not going to get a gas tax out of them. So we have to raise gas tax. Or let's assess a higher fee to those driving electric vehicles. So your registration for your car, you may not be paying gasoline tax. You're like, ha, no gasoline. It doesn't matter. What do they do to your car registration? They raise it. So instead of saying, why don't we keep finding a place to reduce, taxes, and especially in California, go higher and higher and higher. Right? 9% sales tax. You guys remember when it was 6? How many of you, when it was 6% sales tax, have received a 50% increase in your pay? Because that's what happened. The tax went from 6 to 9. That's 3% increase. So 3 out of 6, that's half of it. How many of you received a 50% pay increase in the last 8 or 10 years? Most of you know. So I share that with you because even in retirement, folks, you are going to expect taxes, if you choose to stay in California, to go higher and higher and higher, especially if we continue with a one-party state. It's just the way it's going to be. Look across the nation. We saw, Detroit and Michigan are just a little bit further ahead of the road than we are, and they're collapsed as a functioning entity at least, right? They've had to shift back to more of a fiscal conservative approach. That's the only way it's going to last.
Yeah, and there's no wonder why we're seeing an increased number in people leaving the state of California, whether it's by default or it's by design, where they say, look, I don't want to pay that anywhere from 9 to 13% extra income tax on top of the federal tax for my retirement income. So they're going to go somewhere where it's more tax friendly. Now, they might pay more for gasoline or bread or property taxes, but by and large, high income earners in retirement, they're looking outside of a highly taxed state to live. But if you choose to live in a place like California or any other state for that matter that has a high income tax, it brings even more merit to finding tax-favored or tax-free retirement income streams. Cash value life insurance policies, let's make the assumption here that we've funded it properly and it's built up enough cash value, and oh, by the way, you probably stopped paying on it years ago because you have enough savings in the account that it's billowing and it's making interest on itself. That's a good plan. And then, oh, by the way, we get to take some of that money out. Let's take a look at this for a second. If you were to take money out of an IRA and you have to pay federal and state income tax, let's say at 30%, and you wanted to take out $1,000, it's going to take another 30% just to have $1,000 in your pocket. You pull $1,000 from a cash value life insurance policy, you're probably going to see $1,000. And that's all that had to leave your account.
So you will have plenty of options when it comes to withdrawing the money. If these were built, what I say, properly to begin with, where they were built to minimize the amount of life insurance, because the purpose of this wasn't to have a large death benefit. It was instead to have a lot of cash withdrawal for your retirement years. If it was built that way, or you changed it along the way, because you can do that, then your life insurance benefit may be a little lower or a lot lower, but the amount of cash income you can take out is much higher. So there are ways to modify these, and if you have one of these types of permanent accounts, your broker gets paid a function of the life insurance amount, the death benefit, not how much you put in. I mean, it matters, but more importantly, so if you had $1 million in life insurance, the broker gets paid a higher fee than if it's $100,000. Okay? So it's in their best interest to have the higher amount, and maybe yours too, or maybe not. So you need to check to make sure that if it's something that is right for you, great. But double check and make sure that there's a way to make sure you are not overpaying for insurance, or for your retirement account for that matter.
Yeah, it's a big deal. And remembering that some of these programs will have multiple benefits. You could see from one policy that you have enough life insurance benefit that if you pass away, your family is made whole, your obligations are made whole. And it can have cash value, which could help supplement your retirement income. And if you were to get sick, you would have accelerated access to the death benefit and or the cash value. So you might see that one plan takes care of multiple parts of your financial life and even some of your health concerns, because really what it boils down to is if you get sick, you have to pay someone to either take care of you or administer care in some way. So remembering that one policy could do that, but it's not unheard of to have one or two or even three types of plans that can take care of different needs of your life as well.
That allows you to build the right amount. So just in recap, life insurance gives you potentially tax-free benefits to your beneficiaries, and it allows you to live a life that's basically guilt-free You can spend your retirement money. Don't worry about leaving money for your son or your daughter or leaving the house. You can do that and do it through life insurance, even through retirement. You may consider wanting to sell it. It's become more and more popular, and certainly a lot of companies are doing it now, where they are buying your insurance policy, giving you a flat rate, and in return, owning the policy. So when you die, they collect the death benefit, but you got an upfront cash payment years earlier. That's another option. And finally, I want you to consider, as we were just briefing, there is a tax-free option for you as you're alive if you are ill, if you need help medically, if there's a nursing home that your life insurance may be able to provide. So reasons to keep life insurance in retirement, you can go to hometownstation.com, click on Total Financial Solutions, and send us an email if you have a question, or go to 753-9683 on that magic phone you have, 753-9683, and that's our phone number. Total Financial Solutions, that's me, Jeff Gerard, right there. We're on AM 1220 KHTS. I'm Arif Halaby, Jeff Gerard. Every week at this time, go to hometownstation.com. Arif Halaby on AM 1220 KHTS.